Assalamualaikum warahmatullahi and welcome everyone. In this video, we will be discussing one of the short standards, which is MFRS 5, non-current assets held for sale and discontinued operations. For this presentation, I would like to give credit to Deloitte on its publication on assets held for sale and discontinued operations, a guide to IFRS 5, March 2008, and IFRS Community on assets held for sale IFRS 5, April 2020. For this topic, we will be looking at the objective of the standard, the overview of the standard that includes the measurements, the criteria for classification under held for sale and held for distribution to owner, henceforth HFS and HFDTO, and the presentations and disclosure. However, for the presentation and disclosure, I will only share the appropriate paragraphs without discussing them in detail. Before continuing the discussion, let's first talk about the objective of MFRS 5. The standard is all about specifying accounting treatment for assets held for sale and presentations and disclosure of discontinued operations. In short, if the assets met the requirements for held for sale, they should be measured at the lower of carrying amount and fair value less cost to sell, while depreciation on such asset shall be stopped. In terms of presentation, the assets shall be presented separately in the statement of financial position, and as for the discontinued operations, results from them should be presented separately in the statements of comprehensive income. To start, I would like to give an overview of the standard. This will also be, in a way, a summary for the entire standard. We start off with assets, and under assets for this particular standard, we will be focusing on individual non-current assets, which can be either tangible or intangible, and a group of assets, which the standard refers to as disposal group, DG. These are assets to be disposed of by sale or otherwise together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in the transaction. Now basically, this will refer to a group of assets that represent an operation. It can be a single CGU, a group of CGUs, or part of a CGU. So for the disposal group, once it is classified as held for sale or being disposed of, it is referred to as discontinued operation. For detailed definitions of discontinued operation, we can refer to paragraph 31 and 32. However, that is not always the case. We will have a look at this later in this presentation. These assets, be it individual non-current assets or disposal group, can be classified as either held for sale or held for distribution to owner. Both will mean that these assets will no longer be used in the company to earn income for the company. Therefore, instead of keeping them as non-current, they are expected to be in the company for a shorter period until they are sold or distributed, thus reclassifying it from non-current assets to current assets under the name held for sale or held for distribution to owner. For this asset to be classified under held for sale, it must fit the definitions of held for sale as per paragraph 6 and other criteria under paragraph 7 that requires proof that the assets are actually going to be sold, of which is further explained in paragraph 8 on how we assess the probability of the assets to be sold in the near future. One of which, the sale must be expected to be completed within 1 year period. However, there is an exception for this requirement as stated in paragraph 9. Now, if these assets fulfill the requirements in paragraph 7 to 9 after the reporting period, then they are not considered as held for sale for that financial year. However, if they fulfill those requirements after the reporting date, but before the financial statements are authorized for issue, the fact that they fulfill the criteria should be disclosed as per paragraph 41, A, B, and D. For held for distribution to owner, where instead of selling the assets to external parties, these assets are transferred to the owner of the company. Regardless, both ways the assets will no longer be in the company. The criteria that must be fulfilled for these assets to be classified under held for distribution to owner are stated in paragraph 12A, which you will see later is more or less the same with the requirements for held for sale in paragraph 7 to 9. After we determine whether these assets fulfill the definitions and criteria, we then need to comply to the required measurement for these assets. For held for sale assets, we refer them to paragraph 15, where we shall measure them at the low of the carrying amount and fair value minus cost to sell. And if the sales, by exception in paragraph 9, goes beyond 1 year, we need to consider time value of money. Thus, the cost to sell must be measured at present value, and any changes to the present value of cost to sell will be recognized in profit or loss as financing costs. Paragraph 20 to 24 require recognitions of any impairments to the fair value minus cost to sell as loss and reversal of such as gain. Paragraph 25 then specifically requires that we stop charging depreciation or amortization to the assets when they are classified as held for sale. However, for liabilities in disposal group, any expenses attributable to the liabilities will be continued to be recognized, obviously for the reason of being prudent. As for asset held for distribution to owner, we measure them per paragraph 15a, that is, measured at the low of carrying amount and fair value minus cost to distribute. So the difference between a HFS and HFDTO is just the cost to sell and cost to distribute. Whenever these assets no longer meet the requirements in paragraph 7 to 9 or paragraph 12a, they shall no longer classify as held for sale or held for distribution to owner, thus shall follow the guideline given in paragraph 27 to 29. However, if the classification shifts from held for sale to held for distribution to owner, and vice versa, they are still considered as continuations of plan to sell or to distribute. Thus, nothing shall change in terms of measurements and classification in current asset. Paragraph 30 to 42 gives some guideline on presentation and disclosure required for assets or disposal group held for sale or held for distribution to owner, as well as discontinued operations. Now, coming back to asset held for sale, there is situation where assets or group of assets acquired with the intention to be sold at a later date. If that is the case, they should be considered as held for sale at the date of acquisition if they meet the requirements in paragraph 8 and 9 and would fulfill the requirement in paragraph 7 within a short period of time, usually taken as within 3 months. In terms of measurement, it should be measured at the low of its carrying amount and fair value less cost to sell. However, its carrying amount shall be equivalent to the amount as it is not an asset held for sale, thus perhaps taken at its cost, and if the asset is part of business combination, the value should be measured at fair value minus cost to sell. And finally, there is also a situation where assets are being abandoned by companies. Such is not considered as held for sale and must fulfill criteria under paragraph 32A to C. The standard also emphasized that assets that are temporarily out of use is not considered as abandoned. So that's about it really, nothing that we are not familiar with. But the challenge for us is actually at the start. How do we determine whether an asset fulfills the criteria for held for sale and held for distribution to owners? And as always, we might need to use our judgment there. So for the rest of this presentation, we will be talking about the details of those criteria and a bit about the others. Before we discuss the criteria, it is best to first define held for sale. That would help us to understand the term. Held for sale refers to assets that its carrying amount can only be recovered principally or most part of it through sale transaction. The standard also includes exchanges for another non-current asset instead of cash. However, the expected change must be qualified for recognition as a completed sale, and this means for the exchange to be considered as held for sale, it must have commercial substance. The criteria of assets or disposal group to be classified as held for sale revolves around 2 general requirements. They must be available for immediate sale and the sale must be highly probable. For the first general requirement, there is no further explanations in the standard about it, perhaps because it is quite clear. However, the implementation guidance states that a non-current asset or disposal group is available for immediate sale if an entity currently has the intention and ability to transfer the asset or disposal group to a buyer in its present condition. Take this scenario for example. Say that an entity wanted to sell its headquarters building and has initiated actions to locate buyer. Say that the entity intended to transfer the building once it vacates the building, and the time taken to vacate the building is accepted as ordinary, usual, and customary for such assets. If that is the case, it would be accepted as meeting the criteria of immediate sale, since the entity shown its intention and ability to transfer the assets immediately. Now, what if the entity remains using the building until another headquarters building under construction is completed and they could move to the new building? Say that the entity is unwilling to vacate the building until the new building is completed. For this case, even if the entity has a firm purchase commitment for future transfer has been obtained, the delay of the transfer imposed by the entity demonstrates that the building is not available for immediate sale. Therefore, the criteria for immediate sale is not met. Now consider this. A manufacturing plant is planned for a sale and action to locate buyer is already taken, but it still has a backlog of incomplete customer orders. These incomplete customer orders may be the source for not meeting the immediate sale requirement. Say the entity intends to sell the manufacturing plant with its operation. This decision is definitely meeting the immediate sale requirement at the planned commitment date. This is because the incomplete customer orders will be resumed by the buyer, so it will not delay the transfer. However, if the entity intended to sell the plant without the operation, thus intended to complete the backlog orders first before transferring the plant, this will cause a delay in transfer. In this case, the delay imposed by the seller demonstrates that the plant is not available for immediate sale. It stands even if a firm purchase commitment for future transfer of the plant has been obtained. Let's say that an entity intends to sell a property through foreclosure, but it wants to renovate the property to increase its value for sale purpose. If the entity only intends to transfer the property after the renovation is complete, this is a delay that is imposed by the entity that demonstrates unavailability of the property for immediate sale. Thus, it does not meet the requirement. If after the renovation completed and the entity intends to sell it, but before any firm purchase commitment obtained, the entity found environmental damage that requires remediation, the property is still deemed not ready for immediate sale, thus still not fulfilling the requirement. For the other requirement, paragraph 8 gives us some idea on how the sale could be considered as highly probable. First, there should be a commitment to sell shown by the management. Second, active program to locate buyers has been initiated by the management. Third, the selling price of the asset is set at a reasonable price in relation to its current fair value, so that it will not demotivate potential buyers. Fourth, the sale must be expected to be completed within a year after the classification, with an exception stated in paragraph 9. Fifth, there shall be no unlikely changes to the plan that it might be cancelled or withdrawn. And sixth, where necessary, shareholders have been informed and necessary approval has been obtained. For the exceptions of the 1-year period, paragraph 9 allows for extended period if the circumstances that result in delaying the completions of sale beyond the 1-year period is not in the control of the entity, and given the delay, the management still shown sufficient evidence of commitment in continuing with the plan. Example of such conditions includes waiting for approval from court to approve the sale of assets that belong to a bankrupt operation, or when environmental damage discovered at a property held for sale after a firm purchase commitment was obtained and the buyer agreed to a plan to rectify the damage by the seller, even if it takes longer than the intended completion of sale period beyond a year period since the classification. The property will remain to be classified as held for sale. Extensions of period could also be allowed in a situation where the market for the asset changes and the entity is not getting reasonable offers even when the price reduced. So long as the assets are continued to be actively marketed at a reasonable price, given the change in the market, the asset shall continue to be classified as held for sale beyond the 1-year period. Now say that the market condition deteriorates further and the assets are not sold by the end of that 1-year period, but the seller would not want to reduce the price further because it believes that the market will become better in the future, resulting in the price offered at a value in excess of its fair value. The decision to not reduce the price may demotivate potential buyers. Thus, in this situation, conditions for an exception to the 1-year requirement in paragraph 9 would not be met. Therefore, the asset should no longer be classified as held for sale. The standard also states that regardless of loss of control in a subsidiary due to the sale, assets and liabilities of the subsidiary will be classified as held for sale if requirements in paragraph 6 to 8 are met. For assets or disposal group classified as held for distribution, the case is the same with held for sale. The asset shall be classified as held for distribution in current assets if the entity fulfilled the requirements, which, as you may see here, they are quite similar to the requirements for held for sale. As mentioned earlier in overview, assets held for sale are those assets that carrying amounts will be recovered principally through a sale transaction rather than through continuing use. For assets that are to be abandoned rather than sold, there will be no sale transaction, so their carrying amounts can only be recovered through continuing use. Consequently, assets to be abandoned will not qualify as held for sale and should not be classified as such in the statement of financial position. On discontinued operations, again, as I mentioned earlier in the overview, is the components of an entity that has been disposed of or classified as held for sale. However, it is different from disposal group since it should represent a separate major line of business, thus the term operation, or part of a major line of business, or may also be a subsidiary acquired exclusively with a view to resale. Deloitte highlights that it is also worth noting that there need be no link between assets and disposal groups held for sale and operations classified as discontinued. In particular, it may be the case that a disposal group that is classified as held for sale does not qualify as a discontinued operation, perhaps because it does not represent a separate major line of business or geographical area of operations. Or an operation is classified as discontinued even though none of its assets has ever qualified as held for sale. Finally, in terms of presentation and disclosure, in general, the presentation and disclosure should enable users to evaluate the financial effects of the discontinued operations and disposal of non-current assets or disposal group. For specific requirements on presentation and disclosure for discontinued operations, we could refer to paragraph 33 to 36A, the presentations of non-current assets or disposal group as held for sale in paragraph 38 to 40, and additional disclosures in paragraph 41 to 42. You may also refer to implementation guidance to MFRS 5 for examples and illustrations of the presentations and disclosure. That is all about non-current assets held for sale and discontinued operation. I hope this short presentation has helped you to understand the requirements of the standard a bit better. Thank you very much for tuning in, and until the next one, wassalamualaikum warahmatullahi wabarakatuh.